Xinte Energy, a Chinese green energy firm, says on its website that it is delivering light and warmth to every corner of the world. It is also losing tons of money. The maker of polysilicon, a building block for solar panels, expects to report losses of around 4 billion yuan, equivalent to more than $500 million, for 2024. Intense pressure from the government to build up key industries has led to fierce competition and price wars, while demand has stalled, hitting the company's bottom line. Unfortunately for China, it isn't just the solar power industry. Companies across the country are bleeding cash as they struggle with overcapacity and weak spending in a slumping economy. Those problems are leaving China unusually vulnerable as President Trump tightens the screws with a new 10% tariff on Chinese goods and threats of more to come. Nearly a quarter of companies listed in mainland China reported a net loss for the third quarter, the most recent quarter for which data is available. That share has more than doubled from before the COVID pandemic. Profit margins among public companies in China recently reached their lowest levels since 2009. Of about 5,000 mainland-listed firms, profits at China's major industrial firms declined around 3.3% in 2024, marking a third straight year of lower earnings. Many smaller, family-owned firms are also struggling. Many Chinese companies are in cost-cutting mode, putting off investments, shedding workers, and keeping wages in check. This leads to weak demand when consumption is sorely needed. The world's second-largest economy is reeling from numerous challenges, including an epic property market bust and rising debt loads. Construction activity has slowed, and Chinese people, who largely hold their net worth in real estate, are saving money as worries about their future mount. Protests over unpaid wages and other compensation-related grievances have ticked up. China's leaders have turned to manufacturing and exports, but ramped up capacity, fueled partly by state subsidies, has exacerbated gluts in some industries. Many companies have cut prices to try to unload their products, but that just pinches profits further, which leads to even more cost-cutting. It's basically a race to the bottom. The Trump tariff squeezed Chinese companies that sell products to the U.S., with some manufacturers saying they will have to lower prices to stay competitive for U.S. customers. The ups and downs of the solar power market help illustrate why it is so hard for some Chinese companies to stay profitable. Beijing has been spurring local governments and financial institutions to offer subsidies and loans to companies. With new entrants jumping in, supply ballooned, and companies slashed prices to fight for customers. Companies risk losing market share to others if they resist price cuts or curb production. Polysilicon prices were about 60% lower on average in 2024 than the year before. The price of polysilicon has dropped irrationally, Xinte said in a filing, noting an imbalance between demand and supply. Some Chinese companies remain highly profitable. Social media and video game giant Tencent Holdings recently reported a 47% rise in profits for the third quarter, in part because of the strong performance of some of its gaming titles. E-commerce giant JD.com recorded its own jump in profits, boosting hopes that consumer sentiment in China might be improving. Chinese leaders have mostly focused on fending off immediate financial risks, letting down investors who hoped for more stimulus to spark spending. Investors pulled a net $4.4 billion out of Chinese A-share equity funds in 2024, after a net $2.6 billion of outflows in 2023, according to Morningstar. While new U.S. tariffs add to China's economic challenges, most of the revenue of public companies listed in mainland China is derived domestically. People might be overly worried about tariffs, said Nicholas Yeo, head of China Equities at Burden, a UK-based investment company. It is the domestic economy that needs to be fired up.